Hello, traders. Doing Shabba there from DRFX, Swing Trading Mentoring. Gonna be taking a look at a recent trade that was made on the Euro Kiwi Dollar, which provided a trading gain of 120 pips, as I took advantage of the false breakout reversal setup that was taking place within the large range consolidation setup on the daily chart of this currency pair. Now, as you can see here, what we find across the currency market is that the market forms ranges and pennant consolidation setups, but the setup that was formed on this currency pair was that of a range consolidation setup, where the market forms horizontal boundaries of both resistance and support. What was taking place, however, is that the market had initially attempted a bearish breakout below support, but this was followed by the formation of a double bottom signal to indicate the start of a reversal back inside of the consolidation. Double bottoms, along with double tops, ABC signals, and small consolidation setups are among the signals that you will see that usually indicate the start of a reversal back inside of consolidation. Here you can see the typical examples of double bottoms and double tops, as well as ABC signals, as well as on the bottom left hand corner here, a bullish engulfing candlestick formation, which was also present in this trade and which was provided by the market as a follow-up to the double bottom formation. Here you can see the range consolidation setup on the daily chart that was formed, and the bearish attempt to start the breakout below support that was eventually taken out by the formation of this double bottom setup here. This was then followed by a movement back inside of the consolidation and the formation of a bullish engulfing candlestick formation, which you will see a little bit more clearly in the next slide. And this was indicating the continuation of the movement bullish and a reversal back towards the resistance boundary. Now here we can see the bullish engulfing candlestick formation that followed the double bottom formation, and essentially was providing confirmation of the continuation of the movement bullish, as well as providing us with an entry signal to take advantage of this rally. Now, the two elements of risk that prevented me from actually trading this on my live account and led me to actually trade this only on the Dukascape trading competition demo account was the fact that the double bottom formation was characterized by fairly ordinary bullish candles that you can see here. And normally what I find is that once setups and signals are characterized by these fairly ordinary looking candles, there's normally a greater element of risk associated with trading them. So even though the market may initially respond to them, and in this case start the rally, what can take place is that the market can eventually reverse and take out signals because of the weakness of this initial setup. Another element of risk had to do with the signal itself, the bullish engulfing candlestick formation. On its own, it looks fairly strong, but what I found is that these size signals have a lower chance of actually working out compared to other signals that are larger than this. So skipping this setup for a minute, this was a signal that was given here on the left hand side for this trade, but relative to the ones here on the right hand side, it is much smaller. And what I found is that whenever the market provides signals that are similar to the ones on the right hand side, those trades actually provide a much higher chance of actually working out. So I have a general preference of trading these types of signals on my live account compared to the ones on the left hand side. As I said before, the ones on the left hand side generally work out from time to time, but my comfort level actually leads me to prefer to trade the ones on the right hand side because of the much higher chance of a successful trade. So these were the two elements of risk associated with these signals, with this trade. Nevertheless, this would have been the trade setup. Stop loss was placed below the uptrend line here on the 4-hour chart, which is normally a very good area to protect the trade. Entry took place at the close of this candle here that coincided with the close of this daily candlestick signal, and the trading target was set at 100 pips. So instead of trading this on my live account because of these elements of risk, I traded it in the Dukascopy trading competition, and as you can see here, the trade actually worked out and provided me with a trading gain of 120 pips. 100 pips is a normal maximum on my live account with regards to these types of trades. But since this was a demo account, and it was a trading contest, I decided to push it a little bit and be a little bit more aggressive. And so this was why I was able to capture this trading gain of 120 pips. So this trade would have worked out on my live account and would have provided me with a strong rate of return from this trade alone. It would have added to the positive trend of gains since February, since the start of my new trading approach, which so far has provided a strong trading gain of 16% and has led to the first target of 14% being hit, with 30% trading target, now the next one in line, ahead of the other larger trading targets that are expected to be hit in the months ahead. So the overall elements of this trade, despite the fairly ordinary size of these candles, the main technical elements were that the daily chart had formed a range consolidation setup. It was a false breakout reversal that was taking place, and that was indicating a movement from support to resistance. And the double bottom formation was a signal that was given to indicate the start of the reversal, and this was followed up by a bullish engulfing candlestick formation to confirm the reversal, the continuation of the reversal back towards resistance. To take advantage of setups like these, the uptrend line on a 4-hour chart normally provides a good area and a very strong area to protect the trade until our trading targets are hit. So to protect the trade, the market will, as the market is going towards our targets, it will pull back from time to time. But once you place it at a area just below a trend line, an uptrend line that is strong enough, it usually is a good area to protect the trade against these types of temporary pullbacks until the market eventually hits our target. So the main elements of this trade conformed to the main technical aspects of consolidation setups and false breakout reversal setups, double bottoms, and bullish engulfing candlestick formations. The only problem had to do with the lower level of probability of this trade working out because of the smaller size of these candles. Nevertheless, these setups do work out from time to time, and they can still be considered as part of a live account trading strategy. And so in the days ahead, I will be reconsidering this to be included as part of my overall approach to taking advantage of these types of setups on my live account.